Let's talk about March and the events of March. I mean, I think there's 100 different things that we could talk about in the 20 minutes that we have, and we made a pact backstage to not talk that much about policy and instead focus on some of the cool stuff. But you made an interesting comment that I wanted to start with that I think is kind of fitting and dovetails off of my opening remarks, which is, out of crisis comes some opportunity. Out of every black eye that this industry faces, because it's anti-fragile tech, there's usually some type of positive repercussions. And you made the comment that after the SVB debacle in March, which you were not unexposed to at the time, there was a lot of positive developments that people might not have an appreciation for, specifically for stablecoins and for Circles. So do you want to just kind of talk through like your experience in the last 12 months? Because if you look at stablecoins and kind of Circles performance in general, you're one of the primary beneficiaries, I'd say, of some of the rising rates, because stablecoins now have some real economic tailwinds, beyond just their utility, but now their earnings power. So you've had maybe a slightly different experience as a company in the last 12 months than some of the other folks in the room. What's the silver lining here?
Yeah, I mean, so a couple things. I think we actually publicly disclosed our 2022 financials and our first half 2023 financials recently, and we grew pretty dramatically last year to almost 800 million in revenue and about 150 million in EBITDA, and then in the first half of this year, again, revenue approaching $800 million in the first half, and a couple hundred million of EBITDA. So we've really seen the business grow a lot, and that's allowed us.
I think most people in crypto don't know what EBITDA is because it's cash.
Profits, cash.
Yeah.
Yes,
So,
that's right. That's right. A lot of fintech companies don't know what that is, but what's interesting is that's allowed us both last year and this year to invest a lot. We've been investing a huge amount in product and in infrastructure, and one of the biggest investment areas is, frankly, what I broadly will call kind of liquidity and market infrastructure.
Yep.
So when you think about a digital dollar, our mission is to have sort of the largest dollar stablecoin network, the most widely used dollar stablecoin network in the world. And in order to do that, we want to make sure that wherever you are in the world, that you can very easily get access to these digital dollars and then, of course, transact with them. And if you think about the crypto industry, up until March, it was the financial infrastructure was highly concentrated in the US, single points of failure with Silvergate and Signature Bank, just as examples. And what was remarkable about what happened in really the first quarter of the year, you had, on the back of FTX failing, right? You had kind of runs that began on Silvergate. You had a lot of concern there. You had then guidelines from the federal regulators, the banking regulators, in January that said, we're gonna have a lot more intense scrutiny on activity here. That kind of created a risk-off environment in terms of financial institution work. And then you had this basically enforcement action after enforcement action after enforcement action. So the sort of these huge shots being fired at U.S. entities largely. And then you actually had a regional banking crisis that had nothing to do with crypto, but a regional banking crisis, which saw several banks. Now it's, I think, at least 5 or 6 banks that have failed, but that has cascaded. So you had a pretty dramatic set of things happen, and I think all of that combined led a lot of people around the world to say, I need to find ways to operate in this market outside of the U.S. And
Circle needs to be protected from the systemic risks of the U.S. financial system.
Well, yes, in some ways that's correct. And so I'll talk about 2 things here. One is, on the other side of this, we've dramatically improved the market infrastructure of USDC. So, and we're very proud of our transparency on this. We have, approximately around 95% of the reserves are in what's called the Circle Reserve Fund. That is an SEC registered and supervised government fund structure. It's issued and managed by BlackRock. It provides daily transparency into all of the underlying instruments, which are basically 90-day or less treasury bills, and then overnight or reverse repos that are over-collateralized with global systemically important banks. And so that's there, and cash in essentially the least risk, the sort of lowest credit risk, largest dollar cash custodian in the world. And that is what is USDC. And so USDC, and anyone in the world can see that, it's transparent, it's audited, et cetera. That makes USDC by far now the safest digital dollar in the world on the internet, and that's a good place to be. So we've improved our infrastructure. But the other piece is sort of, companies, 5,000 companies or more were debanked.
Yep.
In a matter of 7 days, basically. 5,000 companies were debanked. And so that created huge issues in terms of the liquidity of this market. And so what's been going on is, for us, we're building a distributed network of banking and liquidity. And we're really, really proud. We're bringing online local banking in critical markets like Singapore and Hong Kong and in Latin America and Europe and other places, so that entities in those markets can very easily attach to this digital dollar network and create and redeem USDC without having to go and open a bank account with a small community or regional bank in the US. They can work with actually major banks in these other jurisdictions. And so for us, the ability to invest and scale and build those kinds of partnerships has been a huge piece. And so, like you said, in the aftermath of these things, there's huge opportunities to significantly improve infrastructure, and that's exactly what we've done.
I think everything that you just said on the stablecoin market in general, it's probably the market, like I'd argue maybe the top one market within crypto that has product market fit. I mean, the lines are just straight up regardless of the bear market. All of the interfaces with the traditional banking and financial system, like those seem to be getting more robust and healthier with each passing year. And yet we did see a divergence after March between Tether, the largest, we call it Eurodollar, right, offshore, and USDC and kind of the domestic stablecoins. Is that entirely due to the slowdown in common sense public policy frameworks, or what else drives that? You mentioned USDC, there's been a lot on the liquidity management side and improving that, but what else is driving that? I think
there's a few things. I mean, I think the irony is that over a roughly 3-month period, what we saw happen is a flight from safety. So we saw people move from transparent, regulated entities to opaque, offshore, unregulated, and not even known banked entities, and that was viewed as more safe, literally. And I think there's a mythology around this, right? There's a sort of, hey, if you're kind of offshore, you're not exposed to the U.S. government or U.S. financial system. That's complete BS. I think offshore entities are holding assets within regulated financial intermediaries in the U.S. And if there were to be regulatory challenges, that can be stopped in the same way that you've seen other incidents happen. So I think there's a mythology around that. But I think there's another piece to this, which is, the upside of a rising interest rate environment for a stablecoin issuer like Circle is that, yes, the monetization is significant, and you can see that in our publicly shared financials. But there's a real opportunity cost, and so if you're a traditional financial institution or you're have access to the traditional financial system and you've been using dollar stablecoins, the opportunity cost of holding a non-interest-bearing stablecoin is high. It's 5.25%, and so we've sort of seen, dating back to like April of last year when the first rate hike started, through today, we see direct correlation there. And I think because USDC has seamless integration to the US financial system. Like anyone with a retail bank account, an institutional bank account can seamlessly redeem and move out. We redeem like $1 billion a week. We issue about $1 billion a week. So we have seamless liquidity and it's easy to do. That impacts that as well. I think my own view is that what's interesting is as you've seen the interest rate environment stabilize and the sort of talk about the Fed being done. Well, I guess we'll hear something today. We've sort of seen that kind of behavior stabilize as well. But it also it's leading to innovation. So there are probably 10 startups that I know and a couple of very large companies that have launched or are launching tokenized money market fund products. And USDC is the way you actually create and redeem those. And so USDC as a cash settlement layer for tokenized real-world assets, that's a great opportunity as well. And we're seeing action there. And I think the market structure and market infrastructure of the on-chain financial system is going to be one which provides people with real-time liquidity in and out of various types of cash management infrastructure, obviously on-chain natively generated lending infrastructure, and then obviously global scale payment utility that works at internet speed and internet cost efficiency. And those are all part of what we're seeing kind of be built and emerge.
Did you see Bill Gurley's talk the other day at the All In Summit? Have you heard about it? Have you seen it yet?
Yeah, I did.
Regulatory capture.
I did see that, I'm happy to comment on that, which is, first of all,
well, good, because I was going to ask about it.
Yeah. First of all,
well, and let me frame it a little bit differently so that it's packaged the right way, and it's not just what do you think about this open-ended.
Sure.
I'm curious, and this is part of the answer. In 5 years, what does the stablecoin market look like in terms of market share? What should it look like, right? Winner take all, I could argue, that's probably not healthy, but there's, obviously Circle should be one of the big ones, and a lot of the tools that you're building,
right?
Ideally is
And right now we have like 20% market share.
Yep.
So it's there's a long way to go in terms of growth. I mean, look, in terms of 5 years from now, anyone's guess, but clearly the incumbents, by the way, are not the stablecoin issuers. The incumbents are the big banks and the companies that manage electronic dollars today. There's approximately 25 trillion electronic dollars in distribution in the world, and that's the TAM. We want to see more of those electronic dollars be actual digital dollars that are fully reserved, not fractionally reserved, and that operate natively on blockchains. And that will be an evolution. And so in 5 years, is that $3 trillion? Is that $5 trillion? I don't know. If you look at the global TAM, it's about $100 trillion. So we are obviously a tiny, tiny fraction of the market. And the regulatory capture, by the way, I mean, there's an assault against passing comprehensive stablecoin laws by the banking industry, and there has been. And so when we actually look at what we're trying to do, we are actually trying to agitate for the establishment of a regime that would make it possible for a competitive playing field to exist in payment systems in the United States that is not based on fractional reserve risk-taking, that's based on a safer foundation, which is full reserve money. That is a real structural challenge, and to create a regime that allows startup companies, established companies, banks and non-banks to all compete in that market. So we want to see that, and that legal certainty would actually allow this industry to develop and flourish. Without that legal certainty, we're in a gray area, right? And so major companies, major consumer companies, major e-commerce companies, other financial institutions, they're not going to build on stablecoins if it's in that kind of gray area. Yep. And so I think the notion that this is Circle trying to do regulatory capture is complete BS, because we are up against a giant industry that is built on an insane amount of regulatory capture today. Yep. And we're trying to make structural changes for how you can compete in that broader money and payment system world. And so I think it's quite different than Mark Zuckerberg saying, please regulate us, where you're a multi-trillion-dollar established infrastructure and you want, you already have kind of massive structural barriers and you want to embed those in law. That's a completely different picture.
I want to talk about the apps you're excited about, but just to close the loop on this one thread, I think the best question that I saw on Twitter when I kind of put it out, what would you like me to ask Jeremy and some of these other folks, it's from our friend Dan Matuszewski. And it actually, I think, is a good bookend here for the discussion on regulatory capture. And it's not capture per se, but it's fortuitous timing, I'd say. And he asked, how much of your competitive advantage, how much of Coinbase's competitive advantage, so I'll ask Brian the same question tomorrow, comes from just having that early access to banking and having those now decade-long relationships that gave you the wedge in before everything kind of went into a holding pattern and a freeze. And in some respects, is good public policy and the frameworks that you and others are agitating for, does that actually reopen the playing field for other folks that didn't have that 10-year head start?
I think, I mean, as you know, because you've known us for many years, I mean, look, it was very clear when we started the company 10 years ago that if we wanted to build a system where you could take traditional money and operate it over blockchains, which is always our vision, that integration between and interoperability between the existing financial system and this new internet financial system, it absolutely required compliant, regulated infrastructure. And so we, from the very earliest stages, invested heavily in compliance and in licensing and regulatory around the world, and always going in through the front door and working with policymakers and regulators, and that's been really key. My vision is not that there's like this alternative universe that is completely free of any intervention from governments, and it's a different monetary unit, and we're just all living over there. That may exist.
Yeah.
Our vision is how do we make this, how do we get this technology working at a mass scale for all of humanity, and look, that integration and interoperability is really, really key. I think that has been really important to our success over the years. And it's not just access to banking, because I think there are thousands of companies that have had access to banking. And I don't think it's frozen right now at all. In fact, I think there are more banks all around the world, more banks than ever all around the world, that are ramping up their involvement in this industry. And so I'm like way more optimistic than I've ever been about the amount of regional as well as global banks that are investing to support growth in the digital asset industry. Look, I think we do need clear rules of the road, so that everyone understands as a financial intermediary what your obligations are under the law, and we need that, and that will unlock more. Again, I think of it as integration and interoperability with the traditional financial system.
We have Dante speaking, Heath speaking from your team as well, so we'll hear their thoughts on the stablecoin bill and the different proposals, and kind of go down that rabbit hole for anyone that's interested in double-clicking on the legal and policy side. But we'll take the last couple of minutes. You just had a whirlwind world tour, Korea, Singapore, now here. What are the apps that you're most excited about? Because if we can actually get digital dollars, fully liquid, fully interoperable, and kind of operating in the hundreds of billions or trillions of dollars of market value, that feels like it's good enough. If that's all that real-world assets offers for the next 5 years, that still feels like it's good enough, because it's so transformative. So what have you seen that you're excited about in terms of either other intermediaries, building integrations, or kind of new novel applications using stablecoins?
Yeah, a couple things. I think first, there's a really significant trend going on right now, which is we're seeing all around the world, consumer-facing, kind of financial super apps, fintechs, digital wallets, other companies that have these large distribution in Latin America, in the Middle East, in Southeast Asia, East Asia, et cetera, connecting to blockchains. And that's a really big deal, because in the aggregate, when you look at these companies, like a Mercado Libre in Latin America, where we announced a partnership a couple weeks ago, they have a couple 100 million users. Mercado Pago has 70 million users, enabling USDC. or Grab, where we announced a partnership last week. They are the super app of Southeast Asia. We've helped them. They've built on our Web3 services and have launched a Web3 wallet in their super app, initially in Singapore, but eventually that will enable potentially a couple 100 million people to connect to blockchains and interact and use stablecoins and other things. These are significant. And so when I look at the consumer scale internet companies, commerce companies, fintech companies, these are not crypto companies. These are companies that are integrating to Web3 for the use of blockchains, for the use of stablecoins, for the use of programmable money, for the use of NFTs. They're doing this not so people can trade Bitcoin. They're doing it so they can bring utility to users. The technology is becoming more seamless and transparent and safe and simple to be able to do that. That leads me to believe that over the next 12 to 24 months, we will easily have 1 to 2 billion people that are connected to these networks. That's very exciting. So that's something I'm seeing happening, and we're obviously trying to do our part to support that. I think the other thing is there's not a huge amount of talk. I mean, like you said, there's a lot of talk about policy. There's not a huge amount of talk about technical innovation. And right now, I'm a technologist by background. That's what I've done my entire career, is work on and work partnering with and building technologies. And like the state of play in terms of what's happening with blockchain infrastructure, with abstractions that will make the usability of blockchain networks simple, where the crypto becomes invisible to the user, where you can interact across chains seamlessly, where you don't have to worry about gas fees paid in crypto tokens that are meaningless to you, and to be able to onboard without needing to worry about the safety of seed phrases. Like the usability, the scalability, the interoperability, like it's all happening right now in front of us. And so I'm way more optimistic than I've ever been about the state of the technology curve and the kinds of app experiences that people are going to be delivering. Even this year, we're going to see a lot of products launching and into next year. So, that's what I'm excited about. I'm just seeing a lot of the building blocks that we've all hoped would come in place are falling into place, and that's because there's great entrepreneurs and great technologists that keep plugging away and building.
A lot of embers in the fire, just a matter of when the tailwinds hit. So, as we've seen multiple cycles now. Well, Jeremy, last question. Are you going to be able to get Elon to avert his gaze from Dogecoin to USDC, so I can get my royalties?
No idea.
In USDC?
No idea. No. That would be nice.
All right. Keep working on it.
All right.
Jeremy Allaire, thank you very much.
Thanks, Ryan.
Fun.